History was just made, and then broken. Silver and gold just experienced a statistical impossibility, a 10 sigma event meant to happen once every septillion years. This wasn't random. It was an engineered takedown. While paper markets crashed, physical silver in Shanghai still trades at a massive premium. This is a declaration of financial war, a desperate act by failing systems. The coming storm could dwarf 2008. Stay tuned. Investigate wealth. If you're serious about understanding the truth behind these market shocks and protecting your wealth, you are in the right place. Hit that subscribe button and ring the notification bell. We don't just report the news, we investigate the collapse and reveal what comes next. Your financial future depends on this intel. Join us now. What you witnessed yesterday was not a market correction. It was not simple profit-taking. It was a financial singularity, an event so statistically absurd it defies the very mathematics that modern finance is built upon. The precious metals market, the oldest and most foundational market in human history, did something it was never supposed to do. We are talking about a 10 sigma event. Let's break down what that means, because this is the core proof that what happened was a deliberate, coordinated attack. In market statistics, sigma measures standard deviation, how far an event strays from the norm. A 5 sigma event is exceedingly rare. A 6 sigma event is considered a virtual impossibility in a natural market. Yesterday, we witnessed a 10 sigma move in silver. The probability of such an event occurring naturally? Statisticians calculate it would happen roughly once every 5.25 septillion years. Let that number marinate. A septillion is a 1 followed by 24 zeros. The universe itself is only roughly 13.8 billion years old. This probability spans time frames so vast they are meaningless. It is the statistical community's way of saying, this cannot happen, unless it is engineered. Anyone claiming this was a normal, healthy market move is either profoundly ignorant of basic financial mathematics or is actively participating in a nefarious campaign to deceive you. There is no middle ground. The tape doesn't lie. The numbers scream manipulation. Now, where did this impossibility occur? Not in the physical markets where real silver changes hands. No, this atomic bomb detonated in the paper markets. The COMEX, the bastion of paper derivatives, traded a staggering 1.84 billion paper ounces of silver in a single session. To grasp the insanity, the entire global mining industry, every rig, every miner, toils for a full year to produce roughly 835 million physical ounces. They traded more than twice the planet's annual physical production, in paper, in one day. This volume marks one of the largest trading days in COMEX history. This is the clearest possible signal. The paper castle is at war with physical reality. It was a high-frequency, algorithmic, concentrated bombardment designed for one purpose: to inflict maximum psychological and financial pain on holders of physical metal and related equities. They are using unlimited paper claims to temporarily batter the price of a physically scarce commodity. But as we will see, this desperate act reveals not their strength, but their terrifying weakness. This is the system's immune system going into overdrive because it has detected a fatal pathogen: truth. The truth that physical silver is desperately scarce, and the paper promises against it are hopelessly, catastrophically abundant. The narrative they weave from this chaos is one of fear, uncertainty, and doubt. They want you to believe the fundamentals no longer matter. They need you to think the debt crisis is magically solved, that the dollar's reign is eternal, and that your belief in tangible assets was the foolish daydream of a gullible mind. They need you to sell. They need your physical metal to settle their paper bets. This isn't speculation. It's the documented purpose of these derivative markets, revealed in leaked memos from their inception: to induce volatility and discourage public ownership. Yesterday was that doctrine executed with surgical, brutal precision. While the West's paper markets were in freefall, a completely different story was unfolding in the real world, specifically in the East. This divergence isn't a minor discrepancy. It's a 45% premium chasm that reveals everything about the true state of the global financial system. As the manipulated London and New York spot prices plunged, the price for physical silver on the Shanghai Gold Exchange, SGE, held resolutely above $136 per ounce. At one point, the premium for physical delivery in China soared to over $45 above the official paper price. This is the ultimate reality check. You cannot manipulate physical metal in a hand. The Shanghai price is driven by actual voracious demand for delivery. This is where Chinese industry, central banks, and retail savers, the world's most prolific accumulators of gold and silver, go to secure real metal. They are voting with their capital, and their vote says, "We do not recognize your paper price. We will pay a massive premium for the tangible asset." This is a de facto decoupling. It's the financial equivalent of two clocks showing times in different centuries. Fresh, on-the-ground intelligence from China's major markets confirms this dichotomy. In the hours after the crash, the Shenzhen Shuibei gold and silver market, one of the planet's largest physical hubs, was packed with people. But here's the critical detail. Shops were selling silver jewelry and bullion at the Shanghai price, about $136 an ounce, while their buyback price for the same metal was pegged to the crashed global paper price, about $91 an ounce. Even more telling, China's largest precious metals recycler, Rangtong Gold, was reportedly offering a buyback price at a $101 US dollar equivalent, exempt from tax, a clear signal of underlying physical tightness. The message is clear. The East is treating this as a fire sale on real money, while the West's paper system is in cardiac arrest. This brings us to the chilling parallel that has top-tier analysts sounding the alarm. This is a Lehman Brothers moment. Not for the banks yet, but for the precious metals market, the canary in the coal mine. Larry Lepard, a respected fund manager with a Harvard pedigree, stated plainly, "What happened in silver is a Lehman Brothers. This is 2008 redux." Think back. Lehman's collapse wasn't the cause of the 2008 crisis. It was the first major, undeniable symptom that the entire system of derivatives and leverage was terminally ill. The subprime rot had been festering for years before the facade cracked. Yesterday's 10 sigma explosion in silver is that same kind of catastrophic symptom. It indicates extreme, unsustainable stress in the plumbing of the global financial system. The precious metals market, humanity's ancient barometer of fear and trust, is screaming that something is deeply, fundamentally broken. If this is the Lehman moment for the metals complex, what does it precede? The potential for contagion. When the safest, oldest, and most globally recognized havens exhibit this kind of engineered, panic-inducing volatility, it begs the question, what happens to markets built on far shakier foundations? The stock market, trading at nosebleed valuations on corporate buybacks and momentum? The commercial real estate sector, drowning in vacant offices and maturing debt? The gargantuan, unserviceable sovereign debt markets? The cryptocurrency space, tied to liquidity flows? This engineered takedown wasn't just about crushing silver speculators. It was a desperate act of repositioning and survival by the biggest, most leveraged shorts, primarily Western megabanks. They were facing catastrophic losses as silver's parabolic rise threatened to break their paper short positions. They had to reset sentiment, vaporize bullish leverage, and buy themselves time. But in doing so through such an obscenely unnatural act, they have broadcast their vulnerability to the world. They have shown that the only tool left in their toolbox is to break the market itself. This is not the action of a confident, healthy system. It is the act of a cornered animal. To understand the why, we must follow the money and the motive. The idea that major financial institutions would conspire to suppress the price of gold and silver isn't a fringe conspiracy theory. It is settled legal fact. The evidence is a matter of public record, proven in courtrooms and enforced by regulators. What we witnessed yesterday wasn't an anomaly. It was the latest, most violent chapter in a decades-long playbook. Let's review the Hall of Shame, just a sampling of the criminal settlements. J.P. Morgan Chase, 2020, fined $920 million by the U.S. Department of Justice for manipulative trading in precious metals futures markets. Traders admitted to spoofing, flooding the market with fake orders to rig prices. Bankers went to jail. Scotiabank, 2020, fined $127.4 million for fraudulent and manipulative trading practices in silver. HSBC and Deutsche Bank, fined tens of millions each by the CFTC for spoofing and rigging spanning years. Morgan Stanley, UBS, and others. All have paid penalties for precious metals market manipulation. This is the documented ecosystem. These institutions are the perpetual short interest in the paper markets, profiting from a suppressed price. Their motive is threefold: to protect the value of unbacked fiat currencies. Rising gold and silver are a primal vote of no confidence in the dollar system. To maintain control over financial narratives and interest rates. Soaring commodity prices break their models and force hawkish policy they cannot afford. To generate obscure, risk-free profits via paper derivatives at the expense of physical market integrity. Yesterday was this entrenched power structure executing a reset. They targeted the most explosive momentum, silver, with a calculated, overwhelming force of paper sell orders to trigger cascading liquidations, margin calls, and psychological surrender. The timing was also exquisite. The last trading day of the month, and a key physical settlement date. This maximizes pain for funds reporting month-end statements and forces the closure of derivative contracts at artificially smashed prices. It is financial warfare, precise and brutal. But here is the critical, unwavering truth for every investor. Not a single fundamental driver for precious metals has changed. In fact, they have grown more urgent. Physical demand. Global silver demand is projected to hit another record in 2026. Industrial consumption, from solar panels, 100+ million ounces annually, to 5G, to electric vehicles, and coming solid-state batteries that may use a kilogram of silver per unit, is on an inexorable structural climb. There is no asteroid of silver incoming. Monetary demand. Central banks, led by the East, continue to buy gold at a historic pace, openly de-dollarizing. This is a geopolitical fact, not a market opinion. Supply. Mine production is stagnant or declining. The cost of extraction rises annually. The above-ground investable stock of silver is notoriously tiny, a fraction of gold or major equities. The debt bomb. The U.S. national debt increases by trillions per year. Global debt to GDP ratios are at all-time highs. The system's dependence on perpetual currency devaluation, inflation, is absolute. Geopolitical fragmentation. The BRICS Plus bloc is accelerating trade in local currencies, building alternative financial rails, and explicitly accumulating tangible assets. The era of a single, trusted, dollar-based system is over. The manipulators are trying to fight these tectonic plates with paper. They can create infinite digital claims on silver in a computer, but they cannot create the actual metal in a vault. The Shanghai premium is the proof of this failure. It is the market's immune system rejecting the fake price. Every ounce bought in the East at $136 and withdrawn from the system is an ounce that will never again be available to settle the West's gargantuan paper claims. This brings us to the most important perspective shift. Stop thinking in fiat terms. That ounce of silver in your hand did not lose value yesterday. It is the same stable, conductive monetary metal it was a week ago, a century ago, or a millennium ago. What became wildly volatile was the perceived value of the unbacked paper currency you measure it against. The dollar had a 10 sigma event against silver, not the other way around. This is the core mental liberation that the establishment fears. When you internalize that you are not trading metals, but trading faith in a crumbling system, the daily noise fades, and the long-term trajectory becomes crystalline. If yesterday's 10 sigma event is the Lehman Moment for the precious metals complex, then we must brace for the contagion phase. The shockwave never stays contained. The violent repricing in the world's oldest safe haven is a blinking red siren for the entire global financial architecture. We are now navigating the edge of what some of the most respected minds are calling a potential collapse bigger than 2008. Consider the cascade. The mechanisms used to smash silver, high-leverage derivative chains, algorithmic contagion, are the same scaffolding propping up equity markets, sovereign bonds, and commercial real estate. When trust evaporates in one corner of the leverage system, margin calls and risk recalculations spread like wildfire. The failure of a regional U.S. bank just this past weekend was not a coincidence. It is a symptom of the same underlying disease, an interest rate and liquidity environment that is breaking things. The desperate, historic intervention to bail out the Japanese government bond, JGB market weeks ago, was another tremor. These are not isolated events. They are interconnected fractures in a dam holding back a sea of debt. What does the immediate future hold? Extreme volatility. We have entered a period of Weimar-like price action, as one analyst termed it. Wild, gut-wrenching swings in both directions designed to eviscerate both bulls and bears and leave retail investors shell-shocked and paralyzed. The goal is capitulation. They will use volatility as a weapon to steal your metal at fire sale prices. Expect more headline-driven smashes, but also breathtaking, short-covering rallies that will make you question everything. This is the war of attrition. Your strategy in this environment is not complex, but it requires diamond-handed conviction. Focus on physical metal. The paper price is a distraction, a flickering number on a corrupted screen. Your foundation is the tangible asset you can hold. The arbitrage between the paper spot and what people are actually paying in Shanghai, 136 plus, or to a local dealer, with significant premiums, tells you all you need to know about real value. Accumulate on weakness, but only what you can hold outright, without leverage or counterparty risk. Zoom out. Look at the one-year chart. 9 months ago, silver was at $30. Even after yesterday's carnage, it is trading at nearly triple that price. The long-term trend, driven by those unchangeable fundamentals, remains powerfully intact. This is about months, quarters, and years, not the hysterical minutes of a single engineered session. See the shakeout for what it is. This brutal reset has purged the system of weak hands, tourist speculators, and excessive leverage. It is laying a stronger, more conviction-driven foundation for the next leg up. The people who remain are the unshakable core. Prepare for systemic unraveling. This is not just about metals. This is about the failure of the everything bubble. Have a portion of your wealth outside the digital banking system. Understand what you own and why you own it. As insurance against monetary failure, as a non-counterparty asset, and as the ultimate geopolitical hedge in a fragmenting world. The final warning signs are flashing. When the guardians of the system must break the very rules of mathematics to maintain control, their endgame has begun. They have shown you their final, most desperate card. The divergence between East and West will only widen. The physical premium is the canary that will not go back in the cage. This is the moment your foresight is tested. History is not made by those who follow the panicked herd on a 10 sigma day. It is made by those who see the engineered chaos for what it is. The death rattle of a dying paradigm and the violent, chaotic birth of a new one. The transition from paper promises to tangible value will not be smooth, but it is inevitable. Your mission is clear. Secure your foundation. Strengthen your conviction. Use the manufactured fear as your opportunity. The storm is here. But on the other side lies a recalibration of wealth that will echo for generations. The world is waking up, and the basement is where we separate signal from noise, truth from narrative, and prepare for what comes next. Stay vigilant, stay physical, and stay subscribed, because the investigation is just getting started.